Hi, everyone. Welcome to the 125th episode of the Timing Research Show for February 13th, 2017. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today we will be discussing the 177th weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download this or any of the past reports there. I have Dean Jenkins here to moderate again today, so I'm going to go ahead and turn it over to him.
All right, thanks, David. Hey, it's great to be back here. I always enjoy the Timing Research Show. I always learn something new, and it's great to when we have a bit of a debate, a respectful debate about what the market's going to do and some different ideas. And I've got a couple folks on that I haven't been on the show with before, so I'm really looking forward to hearing what they have to say. And again, I always learn something new, so I'm just really looking forward to it. So we'll start off by having to introduce themselves. And I'm going to start with you, Rick Sadler of Hit and Run Candlesticks. Rick, want to just give a quick, a little bit about yourself and your site, what you do? Oh, we don't hear you.
Hey, Rick, you're muted.
There we go. How's that? Is that a little better?
Yeah, sounds good.
Perfect. Okay, great. Hey, thank you very much for having me on today. I appreciate it. Like they said, my name is Rick Sadler, the founder of Hit and Run Candlesticks, and we're predominantly swing trading. We do have an options division, and we do our best to educate live in the trading room all day long, and we just hang in there, make money, make profits. That's the thing to do.
All right.
We look at charts. We look at a lot of charts. Certainly believe in following the chart. Not any politics, that's for sure. And fundamentals, we stay away from that. So we're strictly price and chart followers.
All right.
Thank you.
I look forward to hearing what you have to say about the charts as we get into some of the questions about the market here. But yeah, welcome, Rick. Good to have you here.
Thank you.
Kirt of TradingScience.com. Kirt, introduce yourself and tell us a little bit about your site, what you guys do.
Sure. Well, Kirt Christensen, like you mentioned, probably my most published product that I am known for is ETF Tipping Point. So we create algorithmic systems for active trading. Obviously our goal is to significantly outperform the market and time major market sectors. So, swing trading with a handful of trades per month. And so we've been doing that in 9 different sectors using ETFs and options. So everything from S&P 500 to gold to oil to semiconductors to materials. And, we follow the numbers. We have an indicator, our ETF Tipping Point, that analyzes data that has always been there, and it actually goes all the way back to the 60s where the concept came up, but nobody's used the computing power up until now to kind of put that into one indicator. So we're looking for big market moves and profit from those using regular ETFs, double ETFs, and options on ETFs.
All right, very cool. I look forward to hearing what your indicators and just what you guys are saying about the current market, and as we get into any trades that you like later in the show.
Sure.
Be good stuff. All right. Next on our panel is James Ramelli of Alpha Shark. James and I have been on here several times together, and I always look forward to hearing from James. He's always got something good to say. So James, if you introduce yourself and what Alpha Shark's about.
Yeah, sure thing. So my name is James Ramelli. I'm a trader and moderator here at Alpha Shark Trading. We too run a live trading room from the moment the market opens in the morning to the moment it closes at the end of the day, every single day. And what we're doing in our live trading room is pretty one-track focused. We're looking for unusual options activity and analyzing institutional equity options order flows. So we have a number of tools, one of which we designed ourselves, that goes and scans all of the equity options exchanges in the country during the day, and using our algorithm tries to pick out the most unusual or interesting looking equity options trades being placed by institutional money. We then look at those orders and determine whether or not they present an actionable trade setup for us. And in that effort, we oftentimes get some positions on ahead of really big moves in the underlying equities. Believe it or not, institutional equity options traders can sometimes use information that they're not supposed to be trading with to go ahead and put on an equity options trade ahead of a merger announcement or some other type of big headline catalyzing type of event. So that's basically what we do all day long, try and glean off of order flow what it is big institutions are doing and where they're putting their risk capital, because we believe that they're the ones that create the momentum in the market and give a retail trader the best chance of being successful by trying to back off of their order flow.
All right. Thanks. And again, it's good to be here with you again, James. I can't believe anybody would trade on information they're not supposed to. That doesn't happen.
Shocking, isn't it? Believe it or not, it happens pretty often.
and yeah, right and wrong. There's a bit of a gray zone between them, right? Sometimes, maybe. Mm-hmm. All right, so we're going to move into the questions. So the survey, the Timing Research survey that David does, this week, 62.1% of the respondents think the market's going higher, 37.9% think it's going lower, and based on David's magic algorithm, he gives it a 55% chance of going lower. So apparently the crowds aren't always right. So that's what the indicator says that David puts together. What we're going to do is go through the panel in that same order and just ask question number one. The question is going to be, what direction do you think the market's going, and what's your confidence? We'll go through, just get an answer to that question, and then we'll go through again and get your rationale for it. And that would be a time where you could share a chart and any kind of indicators you're using. So for the S&P 500, is it going to be up from Monday's open by the close on Friday, or is it going to be down? What's your confidence on that? So Rick, what do you think?
Okay, so on the S&P 500, whether it's going to be up or down starting today and then ending on Friday, well, I guess it depends on what you mean by down. I certainly think there's room for a minor pullback, but as far as a trend change, I don't think that's going to come by Friday. So for the most part, I'm going to say that I'm bullish, and we'll get into why here in a bit here. But I doubt we'll close. I doubt we'll close at the highs on Friday, but nor do I think we're going to come down and break any support by Friday. So I know that sounds kind of wishy-washy, but I think I would go with a 65% up.
65% chance up. Okay.
Yeah.
All right. We'll see whether we're all in agreement and have a boring show, or whether we have a divergence of opinions here. Even if we all agree, it won't be boring because we all probably have different reasons for that.
Right.
So
right.
So from Monday's open to Friday's close, up or down in the confidence level, Kurt, what do you think?
I'm going with up. We're in a bullish trade on SPY, on SPY, going back 29 days. So, and every indicator that we base things off shows up. So I give it moderately high level confidence. I guess we're going percentage confidence. I'd say 70% confident up for the week.
70% confidence up for the week. Okay. We got at least a 50-50 split. Okay, James, where are we going from here? What do you think?
Yeah, it's pretty difficult to argue for anything other than bullish price action, especially if the question is, are we going to finish higher from Monday's open to Friday's close? I think it's really hard to argue against a bullish move, especially because we're up 12 handles this morning. With that said, we're not really implying that much action throughout the rest of the week. So one of the things that I always look at is how much the options market makers are pricing into the weekly options. That tells us what they're expecting in terms of movement for the week. If we take a look at the S&P futures options, S&P 500 futures options. The 23-25 straddles for this week are priced at about 16 points. So that means that from today until Friday's close, market makers are expecting a move higher or lower by 16 handles. And if we take a look at the macro data releases we have throughout the rest of the week, there's nothing really major coming out. We have retail sales on Wednesday, a crude number, and then some housing data on Thursday. But none of that really seems to be getting the market excited or implying there to be a really large move by the end of the week. So when we see sort of a boring calendar, macro data wise, we're up on Monday and then they're not pricing very much volatility into the market, I generally think that we're going to grind higher through the end of the week. I think a good question to ask is, everyone says we're really stretched up here, but what reason do we have to go higher? I ask, what reason do we have to go lower this week? I see no real big catalyst on the horizon. Volatility is super cheap. So with that said, I'd 5% level of confidence as well.
Okay, was that 65? You cut just a little bit there.
Yeah, I thought he said 5%.
5%. Yeah, no, it's 65%. I would never say. Yeah, that wouldn't be much of an opinion at all, right? I'd say
Right.
1 out of every 30 times I'm right, but no, I'm 65%. It would be higher if there was some more catalyst this week, but I think that we're very likely to continue to grind higher till we get this 16 handles out of the market that the market makers are thinking. But we could just as easily kind of chop around sideways and sort of drift lower inside of this range through the end of the week. I think Rick kind of had a similar analysis that, we're not going to take out the lows and break significant support. We're not implying that there's enough action being priced into options to do that this week. But at the same time, I don't see us aggressively taking out the highs either, because market makers are sort of telling us it's going to be a quiet one.
All right. Well, we're 3 for 3 for going up so far, and so I'm up next, and I hate it, but I got to say higher too. And I say I hate it. The indicators are screaming bull market, right? It's heading up, and there's absolutely no sign of it turning down. I hate that. I actually hate long trends, chasing long trends. I want to be in it, and you're not getting at the top like everybody. And you just keep thinking, how high can this thing go? When's it going to correct, right? But it's, again, the indicators are screaming bull. And if you're flying a plane in zero visibility, you've got to trust your instruments. Right? You start flying by the seat of your pants, you're going to crash. And I think it's the same thing in trading. So the indicators are screaming high. I have a lower confidence in that, so I'll call it 60%, just because the indicators are so strong, the technicals are so strong. I won't be surprised if we hit a speed bump, right? We do have a handful of economic reports coming out, like James said. I think we got Yellen in front of Congress. Probably not going to say anything new, right? Coming out of those sessions. And even though we've got a handful of decent economic reports coming out over the last few weeks, since the inauguration, it seems that economic data matters way less than what's coming out of the White House. So that may be what's going to drive the market more so than fundamentals in the short term. We'll have to see. It is not boring, right? So 100% up. I think we're all leaning toward the survey respondents, and so David's saying we're all wrong. We'll just have to see. So now would be let's get out through the lineup again, and this give a little bit more of your rationale. This would be a time where you could share a chart if you want to, and just dig into a little bit more. Each of you gave as a kind of a headline of your reasons, but Rick, why don't you lead us off there and just get a little deeper on your rationale for the market going up.
All righty, let's see, share a chart, screen share.
Yeah, it's that little green arrow looking thing.
Yeah, there we go. Okay, you should have a chart up now. All right, this is my one of my monitors that I have my chart on. Got the S&P up here, and one thing, I just put a markup here as we were talking. Today's open just so I can follow it and how we're doing there. But we're pretty strict about following the trend and candlestick signals, which gives us the price action for the short term. We're short-term swing traders, under 2 weeks. So right now you can see that the candlesticks are definitely showing higher. There's just no bears inside. The bull is riding it, right? Or yeah, the buyers are riding the bull right now. And without any sell signal in here, I'm just not going to get too concerned with that. You can clearly see the trend is up. I just kind of drew a little line here, and just what I did is I took this line and just created a parallel on top of it. And as long as we stay in this channel and continue as long as the buyers continue to show that they're interested in moving higher, then that's where I get my 65%. We're going to move higher. We certainly may see a slight little pullback come in here like that. Maybe do a little testing, but overall, I think we stay to the green side. Maybe that's sideways, but we're shooting from today's open, so we'll watch what it does with that. Again, you just can't fight the trend right in here. And this red line, this kind of red box, this is the area I have that if we did pull back and we start cracking through this, then we may have some troubles. And then it's more than a profit-taking pullback. That may be a seller's correction past this area right here. So that's my reasoning for the market moving higher right now.
All right, very good. Looks like you're a TradeStation guy too. So
actually, this is TC2000. This over here is a scanner I use.
Okay, it looks really similar to a TradeStation desktop.
Does it? Yeah.
Very cool. And I'm a technical trader too, so I love it when we mark up charts and give a rationale that way.
Yeah, I think that's the only way to trade. I personally, the charts don't lie. Everything else fibs.
Price and volume are the only realities in the market. Everything else is.
Yeah, absolutely.
They actually happened, right? They actually happened.
Yeah.
All right, Kirt. If you want to dig a little deeper into your thinking there, if you want to show a chart, that'd be great.
All right, I'm starting to screen share here. Okay, so is it popping up? All right, so this is in obviously Thinkorswim. So just a very basic day chart. So, but going back almost a little over a year, just the black arrows indicate where we thought, according to our algorithm, we should go long or short the SPY. And so, we were short all the way back in 2015, had this nice run up there, had a nice short 1 month trade right there, long toward the end of last summer. Then we had a losing trade, and all that uncertainty and the craziness that happened with the election and all that kind of stuff. We were short about the beginning of September. Had a losing trade, but then the beginning of the year we reversed, and now we've been long since the first trading day of the year. And it looks like, so far so good. Everything to the upside. We're up 3% or so in that trade. And that's kind of the rationale. Like you mentioned, price and volume are the facts of the matter. And so we have a volume-based indicator that basically, takes an idea that came out in the 60s and updated it for this century. So we're using computing power to churn through every transaction as it occurs on all the underlyings that make up these ETFs, whether there's more buying or selling pressure, whether the trade went off at the bid price or the ask price, essentially, and doing a summation of that and figuring out, okay, well, overwhelmingly, according to the volume, is there some underlying current that we're not seeing on the surface that's not currently represented by the price action? So that's where we're at right now. And right now, as you can see from the up arrow right there, we're bullish on the SPY.
All right. Very good. Very good. James, if you want to dig in a bit.
Yeah, sure. So, everything that everyone just said there was, I can't disagree with. One of the things that we do is see if we can action and match it with the orders that we're seeing come across. in the equity options market. And one of the things that we noticed today, for example, is that we haven't really seen any big put buyers stepping in. And every time the market makes new highs, we look to see what's happening. Are they coming in and buying big blocks of calls, looking for continuation to the upside, or are they coming in and buying big blocks of puts in charts that maybe haven't made new all-time highs today or new 52-week highs today to try and look for a pullback? And the majority of the order flow we flagged today was to the with coming through with a bullish bias. We saw decent sized blocks of calls and short dated options. But one of the things that I think is important to understand as well is that none of what we've seen today has really been on a long time frame. No one's coming in and buying positions out, through September or the end of the year's expiries, but more so over the next few weeks. That tells us that institutional money is just basically following price action and price momentum right now. We continue to take out the highs. They want to be on that side of the trade. They're not coming in and putting anything on that's, calling for large, broad-based moves in the market through the end of the year or even in individual equities. But we still continue to see a lot of short-term call buying in financials, in other sectors that have been really strong here. So that's the reason for, my opinion. We're looking at what on the chart here on the daily bar and the S&P futures. And what I have is the Ichimoku cloud and then a set of market and volume profile indicators here, and we're above every single level of what should have been resistance for the month. That might tell me that we've run a little side, but nothing about this or equity options order flow is really causing me to believe that anyone out there is expecting a short-term reversal of any kind.
All right, good stuff. Good stuff. Thank you, James. And I use Ichimoku Cloud as well. So here I should be sharing my chart now. Hopefully you guys see that. What I've got is the Dow Industrials, just real quick. I got it up here on a weekly chart. And I just like to remind myself to look back at the kind of the long trend, go, where are we in the long trend, right? And we're about 8 years into an amazing bull market. And I even like to pop out to a monthly chart to remind myself that, and right, these things do correct, right? These things do correct, and when they do, it's pretty exciting. So I just like to, like I said, keep myself reminded of that. But in terms of the shorter term focus, the projection, I use a 60-minute chart for the week. So I'm showing the E-mini on a 60-minute chart, and you can see the indicators are just screaming, like I said. We're way up above the Ichimoku cloud. It's even, in this kind of trend, it should provide some support if it pulls back. I think there's very similar levels that a couple other folks showed, right, in terms of support levels, right? We got rising momentum, green across the board. So you can't ignore that. And so until this, until we get evidence of a change in trend, we got to stay with the trend, right? So it's pretty simple. It's going, it's in an uptrend and there's no sign of it ending. I wish there were more to say about it. When we do get corrections and stuff, that we can start projecting corrective wave levels and the next impulsive wave levels. But on this chart, we're in the initial impulsive wave, and we just got to wait for a new signal to try and project what we're going to do from here. And write it out, let her run, man. So that's really what I got in terms of why I say it's going up, because it's going up, right? It's still going up. There was a great question. So we've been through the first three. The fourth question, David usually puts in a interesting new question every week, and this one was cool. And it says, when you enter a trade, how do you decide on your position size for that trade? Do you set a dollar amount, percentage of account, confidence in the signal, whatever? There were some great responses in the survey respondents, but for each of the participants, I guess it really gets down to risk management. How do you determine your position size on your trades? And we'll just run back down the order here. Rick, you want to talk about that a little bit?
Sure. Could I share a chart when I do that?
Absolutely.
Okay, great. Let's see. Is the chart share screen? There we are. Let me put this screen up here, share. There we go. Sorry, I'm not. All right. My screen should be up. Is that correct?
Yeah, we got you.
Okay, you should be seeing Trox. I want to. This is what I use, and a lot of our members use this as well. It's a program we have that lines out basically a trade plan. So when I enter position, personally, I use a dollar amount, and it's all set up by the trade plan. I go in the back end of it, and I set up what I want to accomplish for the year, and then the trade planner kind of spits out the numbers. And right now, it's set here back, and this was, I had this set sort of when we were back in pre-election, and I just haven't gone back and changed it. But what I do now is, because the market has been so bullish, I actually double that. So when I look over here to buy the shares, I'm actually buying double the shares, and I plug in the double. I set my targets, put my targets in, and once I buy it all, this is all. Then I just move this over to executed, and it tells me how much I can make. I usually buy one position, and I'm selling 2 swings into it. In Trox's case, here's 1 swing, there's another swing, and then you put your stop in there, and you just know what you can do. Like in Trox, if everything works out according to plan, which we all know that doesn't work out 100% of the time, you can see that. I could end up with about 23.6% of percentage and about $3,500 in profit on the trade. So I hope that kind of answered the question how I do that. When it comes down to it, though, it's dollar amount. And one last thing is, I'm going to say that I don't usually trade more than 50% of my account. Usually more than 50% is not in the market. There are some days that I go over the 50%, but when the lights go out, when the market shuts down, I try to get under that amount. Otherwise, I have to answer to my boss. So, and she says I can only invest so much at a time. But if under 50% is what I'm usually invested in the market.
All right. Very good.
You bet. Thank you.
Yeah, thank you. Kirt, how do you approach
Yeah, when we're talking about options and things like that, obviously the position sizing gets kind of complicated, but the basic definition of what we used is we use fixed ratio position sizing. So as a system is successful, you ratio-wise, you're trading less and less because you don't want to give up the gain. So we're trying to take something that in the beginning is pretty aggressive and then over time becomes conservative. So basically, we didn't originate this concept, but we use a spreadsheet that keeps track and tells us, okay, if the trade makes this amount of profit and you get to the next one, up the size of the next trade. If you lose, go down to this, because it's not a simple calculation, but very powerful, because obviously anybody who's been trading any period of time knows that aside from having a trading plan or a trading system or a strategy that on average makes money, the next most important thing is the position sizing. So I highly suggest you do some research on fixed ratio position sizing.
All right. I don't know if I've heard it. I think we're doing something very similar, but I haven't heard that exact term, fixed ratio position sizing. But
it comes from Ryan Jones in a book back in the probably 20 years ago.
Yeah, because just the English tells me that I think we're doing the same thing there. But I'll explain what I do when it's my turn. James, or position sizing, which is an element of risk management. What are your thoughts there? What do you do?
Sorry about that. For us, it's a really important thing to think about. Since I'm taking all of my signals, or at least the vast majority of my signals, off of institutional order flow, I really need to think about what type of risk that exposes me to. Big hedge funds and investment banks, proprietary trading firms, mutual fund managers, they've got a lot of capital. They can put on positions that I really shouldn't be taking. They can come in and, be net short options or put on 1x2 call or put spreads, things that, should there be a really large outsized move, would end up with a huge amount of loss. So what I do in terms of position sizing is keep positions within a certain percentage of my total book. In general, I'm never going to go over 5% of my total book into any one position, and then never really want to have much more than 50% of my book in as opposed to cash. But what's really important, and this is something that a lot of our traders who are new don't really get, is that the position size needs to be based on how much I can lose at maximum in the trade. So I have a chart here of Under Armour. They reported earnings a couple weeks ago, and I am just using this as an example of a stock that can have an outsized move and can really screw up a trader's not careful with how they manage them. The stock sold off like 25% on earnings, right? And any trader who was long calls in this name going into that may have had a stop loss in place, thinking that that stop would, actually help them manage their risk. But any stock can gap on any given day, right? The market's not open at night. So if I buy 100 calls for $1 in stock XYZ with a stop at 50 cents, I might say to myself, well, I can lose $5,000 in this trade at most. But that's not the case. What if we come in the next day and, we look at a chart like this, the stock's gapped lower 25%, my 50-cent stop, no one cares about that. I'm not going to get it. And now I've lost twice as much as what I thought I could in the position. So for me, rather than putting that stop loss in place, I'd rather just buy half as many with no stop loss. So I know that if the position goes to zero, I haven't lost anything above my loss limit. Now, a lot of people probably don't much care for that type of method because they're telling themselves, well, then I'm losing 100% if the trade goes against me. Nothing says that I can't exit that position early if I see something developing in the chart, or if I see a competing order coming across the tape from an institution that says the opposite of what the order that initiated my trade said. But in general, I need to make sure that I am never carrying premium over what I'm willing to lose in the position, because it can go away like that. I mean, I can probably find 10 more charts this year that had gaps like this, higher or lower on earnings or on a headline, where traders that were relying on stop losses either in the equity or in the underlying option, woke up to a pretty unpleasant surprise. That's how people blow out their trading accounts, is by not being aware of that, and also by putting on positions like the ones I described earlier, being net short options, putting on 1x2 call or put spreads, anything that exposes a trader to an unlimited amount of risk in general as a retail trader should be avoided entirely.
Boy, I couldn't agree more, James. When I see unlimited risk pop up on my order entry manager, I don't like that, right? I don't like unlimited risk. I like controlled risk, right? Those margin calls will get on your nerves after a while, right? So I use the risk of ruin tables that were developed by Professor Nasu Azara, I believe, back in the 70s, and it's a statistical analysis, and it really says based on your trading performance, based on your win ratio and your payout ratio, and your trade size, what's the risk of ruin, right? And I want my risk of ruin to be zero. In fact, I want to be so far away from the risk of ruin, right? The farther away I am on that matrix, then the more profitable I am. So I generally use 2% as my trade guideline. But that's not 2% of my account position size. I brought up a real quick spreadsheet that I use here, and here's a real trade that we're in, right? I'm using 2% max loss on the trade. So if I take a trade and it goes into my stop, the most I want to lose on that trade is 2% of my account. I don't want to lose it. The most I'm willing to lose on the trade is 2%. And James, you make a good point. You can gap below a stop absolutely and take a bigger loss, right? But here's a trade that we just went into this morning in my trading room. We're short on Micron. Micron's been in an amazing bullish move. But as I said earlier, when we were looking at the S&P, I said on the S&P there was no evidence of a corrective trend beginning. But here on Micron, an amazing bullish move. Now we got some evidence of it beginning to correct, right? We've got a lower low, lower high, new low just put in, breaking down below the cloud. And it looks like we've got a Fibonacci retracement zone down here on Micron, down midpoint about 2087. So that'll be a nice 3-4 days, week kind of trade. And you can see I got lines on my chart here, so I don't go into a trade unless I have an entry point, which is this blue line, a stop level, which is the red line, and then the green is my target, my conservative target, and it could go even deeper. And so I use this spreadsheet from those values. What's my entry, my stop, my target? And this simple math just tells me if what would be the position size to take if this thing hits the stop, and I would lose no more than 2%. So on a $50,000 account, it says, hey, you can go short 990 shares, and the position size, that's almost half my account. So I might dial that back and go, that's a big exposure, like if it gaps or something. But I know, at least the max position size I could take on here and be exposed to a 2% loss if it hits the stop. And then, I love trading options. I'm directional, right? If on a bearish trade like this, I'm just going to go long the puts. If it's going up, I'm going to go long the calls. And we teach just position sizing, the same rule, right? If you're only willing to lose 2% of your account on any given trade, only spend 2% in premium. Now, if you're really good and you're at your computer, you can maybe bump that to 3% or even 4%, because if it goes to the stop or even gaps a little, you don't have to hold it to 0. You don't have to lose the whole amount, like James says. You can go get out of the contract and control your loss that way. But I think almost everybody has said essentially the same thing, in that you have to know how much you could lose, and it's got to be a tolerable amount, right? Because you're going to lose some trades, and if that turns out to be a surprise, it's like, oh my goodness, I lost the trade and my account. That's really a setback, right? 2% of the account, you can absorb that, and you can absorb a small string of those, 2 or 3 or 4 in a row. It's no fun. It stings a little bit, but you can recover and move on and still have a good, a good quarter, a good year, right? You lose 30, 40% of your account, and climb out of that hole for sure. So that's what I do. I use the 2% risk of ruin tables and position size accordingly for both stocks and options. That's a great question, a great discussion point. I love, there was a quote in some of the respondents who answered, and one of the respondents said, "We're only 140 characters away from a big pullback or another rise." That's funny. That's funny, and it just underlines the need for having a risk management. Oh, it's totally true, right? I said earlier, I think the market's moving more on what's coming out of the briefing room than economic reports right now.
So really, is it only one character away?
one character who gets 140 characters to make his point, right?
Right, exactly.
Yeah. All right. Well, the next thing here on the agenda is if you got a trade. So I'm sharing this Micron trade real quick here. And I'll share one more too. But each of you, if you got a trade or an idea you'd share with the audience, talk about one that they might be interested in right now. That's where we're at. So, Rick, what do you like right now?
Well, I wish I could show more than one. Let me share my screen here.
Well, we got a smaller panel and we got time, so show a couple.
Oh, okay, great. Thank you.
I might like it, so
well,
you're away.
This Trox, and I've got one more too that I just bought today. Trox, I just yesterday did a trade of the week video on this, and I'll have it posted on YouTube later today, hopefully. And we bought this back here on January 31, $12.50. Our first target is 17% up here, and our second target is at 30%. We won't worry about this one until we can accomplish some of this. Now, I'm not at all saying this is where anyone should buy it.
Were you sharing a chart here? We see you, not a.
Oh, I was here. Let's see.
You're a good-looking man, but I think you wanted to show a chart, right?
Yeah. No, I want to screen share. Oh, there we go. Okay, share. There we go. How's that? There you go. So let me run over that real quick. We're already long this. We're long at 1250 right here. It's moved up. It pulled back, did a little flag, little bottoming action. Price has moved up here. Doji continuation pattern. It's approaching our first target. Now, this is where I'll take 50% of the trade off and then watch the trade from here. But I still expect the trade to move up higher. Now, what I don't expect is it just to keep going higher. Don't expect that at all. What I do expect is a little consolidation, maybe a little pullback. Where exactly it pulls back to, that's the $64,000 question. But if the price action stays bullish and it's just a profit-taking pullback versus a seller's pullback, then what I would like to see is this continue to move up. As it starts to break out again, then I think we have a run at this 1630 up here. So that's at Trox. Now, the trade, this was our featured trade idea today to our members. And I did go long in it. And it's WUBA down here. And WUBA is one of it is my favorite chart pattern of all time. And it's rallied up. And we've had this little pullback Friday, pulled back, nice little wick down here. Put in a bottom, and today's just a little doji. It's just playing around today. You can't really judge the candle till the market closes. But this is my buy box. I just want to buy in this area. I don't focus so much on the entry, as long as I can prove to myself the chart has potential to make money. So I look at this up here and I see a target around 35.35. Then the second target around 37.65, and then around 41.45. I get asked all the time, why am I using round numbers? And the reason I use round numbers is because I'm not trying to suggest this is some exact, perfect target, any line you put up here. So I like to be asked that way I can explain it. But I'm looking at, I just entered this today. So with an entry here today, first target would give me 8%. Second target would give me 15%. We'll see how it acts in here. And I really do believe this could end up at this third target. And that should be somewhere in the neighborhood of, what is that? 25% on double-digit gains. So I really work hard to find those charts that can give us that double-digit move, over the whole trade. So there's my spiel on a couple of trade ideas. Remember the Trox. Make sure that it pulls back. I do not think it's viable where it is. I think it needs a little bit of a pullback, but you can see the trend is still working. So it's make a plan, trade your plan, control the chart. You control the chart by knowledge. So education is the way to go. Thanks a lot for letting me share two charts. I appreciate that.
No, outstanding. And when it's my turn, I saw your WUBA, and it's funny. I got a pattern exactly like that, so I'll show one
cool
as well.
Thank you.
So very cool. Yeah. All right, Kurt, what do you got? What do you like right now?
All right, let me get the screen share going. This is a simple one, be really quick. Currently, this is our only bearish trade right now, and this is on OIH, which is the Oil Services ETF, and it's currently bearish. And the great thing about this Oil Services ETF is, like the oil market, it's a lot more volatile than stocks, and it's essentially non-correlated to the major stock market. And when the trades go bearish, it's fast and furious. As you look back a couple years, there was a quick bearish trade back there, and then we went bullish, bearish trade all there, bullish, bearish all the way to here. And, we had a nice bullish run up 26% or something that we just closed out until a week ago last Friday, and now it's bearish. So I think it has some good potential in terms of these are high probability trades. If you don't like to go short an ETF, of course you can in the 2X ETFs in oil are Dig and Doug. So you would buy the Doug. That's all I got.
Okay, thanks, Kirt. Very good. Very good. James, what's up on your radar screen?
Yeah. So as I mentioned a little earlier, order flow hasn't really given me too much to work with so far today, but and I can't believe that I'm gonna name this as my trade of the week. I actually think one of the better looking setups is a long in Bank of America. If you think the market's going to go higher, and I totally understand how some can look at this chart and think that this is getting way overdone. I mean, the move that financials have had has been crazy, but every single week, and this has been going on since after the election, we see traders come in and put on more and more bullish options positions in financials. Bank of America specifically, for options expiring this week, has seen a ton of action on the 23.5 call line for both this week and next week. So these are trading really cheaply. They're about 24 cents. I think that if we, and I'm glad you mentioned earlier, Dean, that 140 character tweet can really send a pretty significant shockwave through the market. And it's been a theory of mine for a couple of weeks now that a substantive set of executive orders that we see are going to be all revolving around financial industry and most likely with tax reform as well. I think these names really kind of saw a pause at the beginning of the year here because it started to become we started to get this notion that these things would be pushed down the road a little bit, maybe to 2018. And now that he's struggled and there's been no real progress on, the other things that he's set out to do at the beginning here, the wall, immigration reform, I think this will be the next area for them to get a quick and easy win if they want one, would be unwinding some of these regulations as one of his campaign promises. And that could be a really big catalyst for these. I know that a lot of people would argue that that is already priced in here, but if that was the case, then we wouldn't see, the moves that we've been seeing, when we get an executive order on the fiduciary rule or something like that. So money is looking for the next kind of short-term pop, and I think that that's not a bad place for me to be if the broader market telling me that it's going to, that trading like the SPY is going to give me a significant move this week or through next.
All right, good stuff. Just following up on a couple of your thoughts and comments there. In my trading room this morning, I got a really clear signal on Citibank to go long on Citibank, and I just couldn't do it. And I told my folks in the room, I said, the technicals are perfect; they don't get better. But if something makes you uncomfortable, right? Don't let fear dominate your trading. But if something makes you uncomfortable about it, you got to be able to sleep with your trades, right? And
right, of course, and that's the thing. Like, if a trader's looking at this and saying, I just can't bring myself to be long this chart, well, then it's not a good signal. You said you saw something in Citigroup this morning. They came in this morning, and we saw some call activity there. And what, in my mind, makes all of this order flow particularly bullish is that they're not really looking for like huge moves to the upside. They're buying at the money or just barely out of the money calls. In Citigroup today, we saw a lot of the June 60s trading, which is money or so, that they would do that type of high gamma option play, especially in the shorter dated names. That's the type of thing that they would do if they were expecting a more aggressive kind of short-term move to the upside.
Yeah. We had a pretty good rally late last week on, some early news about tax reform, right? You can't tweet tax code, right? There's 600 or 700 people up the street that have to pass those laws. That's a ways out. Right? So it's a little early to jump on that, I think.
Yeah, that's true. But at the same time, they released a statement last week, and I don't believe it was via Twitter. I think it was they actually said it would. No, it's not going to be 2018. We'll actually have something in 2, maybe 3 weeks. So I guess we'll see what that is. I mean, when we get that type of telegraph, the market sentiment changes like right away, whereas a week before that everyone was saying, okay, well, we won't see anything significant on tax reform until 2018, and one sentence later and now we're expecting it next week.
Yeah, but again, there's another branch of government that actually has to pass that law, right? Regulations, yes. Tax code, no. So, so I'm showing a chart here. This is MO Altria Group. I just want to show, this is a trade we took a month ago now. It's been, or a little bit longer. And what I'm showing here is a pattern, right? I like Elliott Wave. I like Ichimoku Cloud. I take a really simple approach to it. You know, we got an impulsive move. We got a corrective move. We got clear evidence using Dow theory and Ichimoku Cloud that a new trend was starting. So we took this trade at 67. We're up here at 72.36. And we've taken profit a couple times, trailed our stop a couple times. We're just going to let this run, hopefully up into the target zone up here at about 74.88 or so. So that's the kind of pattern I'm looking for. That one's too late to get into, but I show that for the trade I do want to show you, which is Baxter, right? Same pattern, just earlier in it, right? So we took an entry at 48.63. We're looking for a target up above 53, and that's still a good trade, still good reward to risk on that one. So I like Baxter as a long. We're in it. We're in a bit of profit, and we're looking for it to run. And I particularly like charts. You know, I'm not trading the indexes right now. I'm looking for individual sectors and individual companies that got their own trend going on or really aren't participating in the, or tied to the index performance. We were trading gold over the last month. We did real well on gold. Looks like it's going to pull back just a little bit, but that's a good example of its own sector. Rick had showed a trade WUBA, and it's funny, that pattern is very, very similar to a biotech that we are in right now. We're doing real well, pretty happy with, pretty excited about, and that's CGIX, Cancer Genetics. So if I blow this out a little bit, Rick, I think that looks a little bit like your setup, doesn't it?
It does. Back there, January, and then breaks out of the 200 period moving average. You bet.
So we took this at $2. Yeah, it's a lower price, smaller cap biotech, got some volatility to it, but it trades at decent volume. And so we took it at $2. We're at 242. We actually have a target on this up at $5, which is based on a Fibonacci retracement to that big, massive downtrend that it had. And so, you know, these rallies doesn't even have to be a change in fundamentals. This can just be a short covering rally. We don't really care why. What we see is clear technical evidence of it heading up. And, you know, we're already in solid profit on this. We're going to start taking some and see if we can take it up to the target. So there I showed, Baxter and Cancer Genetics as some good trades, and that short-term short 60-minute chart on Micron. All right, so we're getting close to the end here. So the final chapter in the show here is where each person just makes some closing comments, and if you've got your website or a link for for an offer or whatever you'd like to share with the folks watching, this is the time to do it. So Rick, if you want to wrap up your part, man.
Sure. Let me try to get that screen back up there again. Screenshot. There we go. Okay. Again, this is Rick Sadler. I'm the founder of Hit and Run Candlesticks. This is our website. You can find us at hitrun.candlesticks.com. I want to talk real quick about some focuses that we have. One of my personal goals is to always look for stocks that can produce some double-digit gains. I just do not feel that 1%, 2% here is going to make a swing trader any money. Great for day trading, but swing trader is just not going to get it because the losses that you will have will just eat your lunch. We do focus on price. We do that through candlesticks, price patterns, support and resistance, and trends. We focus a lot on that. And that's what we teach in the trading room all day long in the Hit and Run Candlesticks trading room. And it is also taught in the Right Way Options trading room as well. If you go to our website, you'll come right over here, this little click here for 30-day trial. It's $14 for 30 days. You get your choice of either Right Way Options or Hit and Run Candlesticks, or you could do both. But if you get a chance to do that, stop in and see us. There's no doubt in my mind you'll take away half a dozen aha moments in a 30-day period. So please give us a shot. Anyway, this is Rick with Hit and Run Candlesticks, and thank you very much for having me on today.
Hey, it's great being here with you, Rick. Thanks for showing up. Good to meet you. And
Yes,
very
sir.
good.
Yes,
Very
sir.
good. All right, Kirt, if you want to wrap up.
All right, quick screen share there. If you're interested in learning more about what we do, go to etftippingpoint.com/webinar2. So etftippingpoint.com/webinar2. And we have a webinar that we put on that explains this, this ETF trading system. 95% win rate, 624 trades in the past 10 years, using well-known ETFs, DIA, SPY, GLD. And we've got an hour and a half webinar that it kind of explains how it works, shows you all the tools, how it comes with the trades and the results and all that kind of stuff. And so, we're looking for new people, obviously, and we're not cheap, but it's we give people a chance to get behind it and show people exactly how it works, and take a look at it if that's something you're interested in. etftippingpoint.com/webinar2. Thanks, guys, and thanks for having me on.
All right. Hey, thanks, Kirt. You're not cheap, right? I like
Nope,
that.
not cheap.
We're not cheap, but we're easy, right?
Right, exactly.
The more the money, the easier you are.
Right. All right, James, if you want to wrap it up there with Alpha Shark.
Yeah, sure. So here at Alpha Shark, we have a huge range of products and services that we offer our customers in an effort to make them better equity options traders. The number one thing that I think would be interesting for those of you that listen to my commentary and want to learn more about unusual options activity would be to check out our live trading room. We're breaking the order flow down in there every day, real time, as it's happening. As you guys have kind of looked at my screen, you've noticed this thing off on the left here that has been spitting out all these letters and numbers and such. These are all the details revolving around actual trades that are taking place in the equity options market right now. And learn a little bit more about this by going to our website and downloading an ebook about unusual options activity. And then in that ebook, you're given a chance to check out the trading room. Or if you have any other questions about anything I've talked about today, or just about what we do in general, or the concept of unusual options activity and institutional order flow, you can shoot me an email, james@alphashark.com. I typically can respond within 24 hours, so I look forward to hearing from you guys. Thanks again for having me on the show here, Dean and David. It's been, oh man, I've completely lost count of how many times I've been on, but always really enjoy being here and chatting with everyone. So thank you guys very much.
Great. Thank you, James. Yeah, it's always fun to be on here with you. So I'm sharing my screen. I'm Dean Jenkins, founder of FollowMeTrades.com. I've got my website projecting here. So I have a stock advisory service, so I have a stock and options pick service. There's a free newsletter, so if you just want to find out more and maybe stick a toe in the water, see what I'm up to, I do a free newsletter on the reality of the markets, projection for the market, and some key commodities. You can get a free newsletter by subscribing here. We do have a weekly stock picks, stock and options. Got a live trading room you can check out there, and here's my report card, returns year on year. And if you want to see the actual details, you just click in, and every single trade that I took in a given year, and whether it was a winner or loser, and how much, all that. So try to be real transparent. And these are real trades. These aren't theoretical. I take every trade with my own money in my own account, and so you can be sure I think it's a good one if I'm going to publish it. So followmetrades.com, and again, a couple options here. Free newsletter, check out our stock picks. You can take a trial, it's a money back guarantee trial, and the trading room. Our trading room's only open for an hour and a half. We're there just for pre-market, and then an hour and a half into the market, and just really identify some key levels and identify a couple good trades, and then wrap it up. So that's what we're up to here. All right. Well, hey, it was great to be here. Thank you, David, for inviting me back and a chance to moderate. As I say, I always learn something new here. It's always interesting, and I always look forward to it. So back to you, David. Thank you.
Yep. Thanks, everyone. Great show. Just want to remind everyone watching to be sure to hit the YouTube subscribe button if you haven't yet to make sure to get updates on future shows. Also, you can go to TimingResearch.com to download any past reports or watch any of the past shows there. Last week, I also posted the show in MP3 format, so I'm going to start doing that every week. If you don't have time to actually watch the show 1 week, you can download it and listen to it on your phone or wherever. Be sure to join us next week. Dave Aquino, Neil Batho, and Ed Carlson will be here. And I just want to thank my guests again for this week. Rick Sadler of hitandruncandlesticks.com, Kirt Christensen of tradingscience.com, James Ramelli of alphashark.com, and Dean Jenkins of followmetrades.com. Thanks, guys.